Most W-2 employees pay the highest effective tax rate of any earner in America. Not because the law requires it, because nobody explained what the law actually allows. Every strategy here works with no business, no LLC, no side hustle required. The single most powerful tax reduction available to W-2 employee is your 401k. Every dollar you contribute, pre-tax directly reduces your taxable income. In 2026, the limit is $23,500. If you're 50 or older, $31,000. If you earn $90,000 and contribute $23,500 to a traditional 401k, the IRS taxes you on $66,500, not $90,000. At a 22% federal tax bracket, that is $5,170 less in taxes from one account, from a benefit you already have access to right now. Most employees contribute just enough to get the employer match. The match is mandatory. The rest of the contribution limit is the free tax cut almost nobody uses. If you have a high-deductible health plan through your employer, you have access to the most tax-efficient account in the tax code, the health savings account. It is the only account that is triple tax advantaged. Contributions go in pre-tax, reducing your taxable income immediately. Growth inside the account is tax-free. Qualified medical withdrawals come out completely tax-free. In 2026, $4,300 for individuals, $8,550 for families. The money rolls over every year. Not use it or lose it. After age 65, you can withdraw for any reason at all, turning it into a second retirement account. If you're HSA eligible and not maxing it, you are leaving the best tax account in the code completely untouched. If you have children under 13 or a dependent, you pay for care. This section will cost you money if you skip it. The dependent care FSA. You can contribute up to $5,000 per household pre-tax to cover childcare, daycare, summer camps, and elder care costs. $5,000 out of your paycheck before taxes. At a 22% bracket, $1,100 less in taxes. At 24%, $1,200. IRS 2023 data shows fewer than 5% of eligible W-2 employees fully use a dependent care FSA. Your neighbor Sandra, 2 kids, $14,000 in daycare costs annually, contributing $0 to a DCFSA, paying $1,100 more in taxes than legally required. It is on your enrollment form right now. If you do not have a 401k through your employer, or your income is below certain thresholds, you can deduct a traditional IRA contribution. In 2026, the limit is $7,000 per person, $8,000 if you're 50 or older. Single filers earning below $77,000 who are covered by a workplace plan can take a full or partial IRA deduction. No workplace plan at all, you can always deduct the full amount regardless of income. This is $7,000 fewer dollars the IRS can touch this year. Kevin, 2024, earns $62,000, no employer retirement plan. Contributed $7,000 to a traditional IRA, reduced his federal tax bill by $1,540, took 20 minutes on Fidelity.com. Most people have never heard of this, the Savers Credit. If you earn below $36,500 as a single filer, or $73,000 as a married couple, and you contribute to a retirement account, the IRS gives you a direct tax credit worth up to $1,000 per person. Not a deduction, a credit. A deduction reduces what you're taxed on, a credit reduces your actual tax bill dollar for dollar. Vanguard 2023 investor behavior data found fewer than 30% of eligible contributors claimed the Savers Credit in any given year. If your income qualifies and you're investing in a 401k or IRA, the government will give you money back for it. You just have to claim it on your tax return. If you invest in a taxable brokerage account, you have one more tool, tax loss harvesting. When an investment drops in value, you sell it at a loss. Immediately buy a similar fund to stay invested. The loss becomes a tax deduction. Offset capital gains dollar for dollar. If losses exceed gains, deduct up to $3,000 of ordinary income per year. Unused losses carry forward indefinitely. This isn't complicated. You sell something that fell, replace it with something similar, and book a legal deduction. Morningstar's 2023 Mind the Gap study found active tax loss harvesting adds 0.52% in annual after-tax returns, compounding into tens of thousands of dollars over a career. Here is the strategy almost no W-2 employee thinks about: your W-4. Most employees fill it out once on their first day and never change it. If you get a large refund every year, more than $1,000, you are giving the government an interest-free loan. That money could have been in your 401k or HSA every single month. Adjust your W-4 to reduce withholding. Keep more of each paycheck. Invest the difference. Don't overpay the IRS and wait until April to get your own money back. Go to irs.gov, use the tax withholding estimator. 10 minutes, it may be the highest return 10 minutes you spend this year. Here is what the W-2 tax code actually looks like when you use it. 401k pre-tax contributions, up to $23,500 in 2026. HSA, $4,300 individual, $8,550 family, dependent care FSA, up to $5,000 pre-tax. Traditional IRA deduction, up to $7,000. Savers credit, up to $1,000 cash back. Tax loss harvesting, offset gains indefinitely. W-4 optimization, stop lending the government your money. None of this requires a business. None of it requires a tax attorney. It requires knowing what's available and using it. Drop a comment. Which strategy here were you not using that you're starting this week? Subscribe. Every week, one tax or money move that changes the actual number.